In terms of your U.S. equity call, your positive single-digit returns doesn't look like a good start to that call, though.
No. No, to get to single digits, we're going to need double digits before long on the upside. Look, this feels to me a lot like August. I don't want to be Pollyannish about it, but a lot of similarities. And China authorities did something then. They'll do some things now, I think,
you have
to make
confidence
a difference.
in them?
Look, I think there'll be guns to their head almost literally to make that happen. They're focused on the economy. They have to be equally focused on the markets because that's exported, if you will, all over the world. And in the meantime, we have a U.S. consumer that I think is doing just fine. Job growth, wage rate gains, much cleaner balance sheet. So look, I'm not pounding the table on the U.S. economy, but it's in okay shape.
We'll see more tomorrow with the big jobs report. Isn't it tough to be a U.S. equity strategist right now? Don't you have to know the prediction for oil prices and the prediction for the Chinese currency?
Bingo. If you can figure out, let me say it this way, for market to be up this year or to come out of the funk we're in the first week, we need stabilization in oil prices and a cessation of the move up in the dollar versus the yuan. If you can give me those two things, and we will get that at some point as we did in August, and stocks will come back to, well, let's pay attention to the U.S. Remember, we are primarily a domestic economy. 87% of our economy is domestic, only 13% is foreign trade, far below any other country.
We were talking earlier about the recovery we've had in the market. We've halved our losses because of the abandonment of the circuit breakers in China. I actually misspoke earlier. I suggested that we didn't have those circuit breakers here in the United States. We do. It's called a level 3 circuit breaker, and it would actually cut out trade for the entire session if we fell by 20%, which we did, of course, 29 years ago with the stock market crash. China isn't in your predictions here. It's not one of your 10 predictions.
Correct.
How can you have a list of predictions that don't include China?
Well, I had one last year, was that China falls below the U.S. in terms of contribution to GDP. Years, China contributed more to global GDP. It reversed last year. That was the question we got most about that prediction because people couldn't believe that would happen. China did slow more than we thought. We did have a second set of predictions, and related to China, it is India overtakes China as the fastest growing emerging market in the world. And I think that will last for years.
That's in the World Bank
India's
outlook.
population will surpass China's in the next 10 years.
In the meantime, this interplay with the Fed and interest rates is fascinating. It's fascinating to see how people dismiss what Stanley Fischer said on CNBC yesterday, that 4 rate hikes is the ballpark figure. Overnight, Goldman's has issued, I think, a really important piece of work, and they have the Fed models. They model if you've got a further 25% decline in oil, a 10% increase in the dollar, they'd still only delay the rate hikes by 1 or 2 this year and make it up in 2017.
Wow.
Many people in the market are not with the Fed. They simply don't believe what the Fed is telling them.
Well, remember August, September. August, we had the China kerfuffle. September, the Fed meets, and many of us hoped, expected the Fed might begin the rate rise, and their whole minutes related to things overseas. If the dollar is in move up and the oil is in free fall, the Fed won't raise rates.
But that's precisely what Goldman is saying they will do. On their models, there will still be 2 or 3 rate rises this year.
Then why didn't I would say to Goldman, then why didn't the Fed raise rates in September? Because all the same fundamentals existed. So look, my view, back to Sarah's questions, this is going to calm down. And when it does, we'll get back to wage rate inflation's moving up, the unemployment rate's falling below 5%. Yeah.
All that said, part of your expectation is that everybody's talking about coming back home, focusing on domestic. You think non-domestic outperforms?
Yeah, I think this will be the transition year. We've had 5 years in a row of U.S. bonds outperforming non-U.S. bonds and 4 out of 5 in equities, and I think the pendulum's going to start switching on the basis that global growth picks up a little bit and foreign trade picks up a bit. I know that sounds crazy given the week we've had, but I think we'll have it.
Within the U.S. market, you like technology. That doesn't surprise me. You liked it last year, and it worked. This year, though, you like financials,
Yes.
which was somewhat of a consensus trade coming into the Fed tightening and just hasn't worked out at all. You looking at earnings next week as a catalyst?
Yeah, earnings, but here's what I think. Of the cyclicals in the market, the financials are the cheapest. And if you're going to own some cyclicals, I think that's where you go. And the Fed can help us by raising rates 2 or 3 times this year, notwithstanding Goldman's comments.
Hey YouTube fans, I'm Landon Downey from CNBC. Thanks so much for checking out our channel. Here you'll find videos packed with all the info that you need to be smarter about your finances. Be sure and subscribe by clicking right here, and click on all the videos around me to see CNBC's original series Young Money, Tech Bet, Kramer's Mad Money, and all the latest from CNBC.